Good afternoon, everyone. I'd like to welcome you to our second installment of the Guarini School of Business Summer Speaker Series. I'd like to give a special welcome to all of our St. Peter's alumni who are joining us for the discussion today. This series consists of a number of timely and relevant discussion topics analyzed and led by our faculty, and in today's session, we are featuring one of our outstanding alumni as well. Today's session, Post-Pandemic Reflections, Observations on Key Sectors, will cover a number of topics on financial markets and investments, and will run in a question and answer format, featuring MBA alumnus Mike Hughes and moderated by Professor Ray Butkus, and this will be followed by an open Q&A session with the audience. Mike Hughes is a Vice President and Private Wealth Advisor in the Consumer and Investment Management Division at Goldman Sachs. He works with entrepreneurs, closely held business owners, C-suite level executives, and significant single-family offices. He began his career in the financial services industry in 2001. Before joining Goldman Sachs, he was a senior trader at Loeb Partners, a multi-strategy asset management firm and family office. And prior to that, he was a senior trader on the proprietary equity trading desk at the Bank of New York Mellon. Mike received his BS in Finance from St. John's University and his MBA in Finance from St. Peter's University. Mike is a mentor at iMentor, a nonprofit organization designed to help educate and empower first-generation American high school students from low-income communities. He is also a coach and mentor inside the firm's career readiness initiative, the Goldman Sachs Local College Collaborative. Many of you know today's moderator, Professor Ray Butkus, who is an executive lecturer of business administration at St. Peter's University. He is the founding director of our Center for Leadership Studies, and he has been the mentor for our Goldman Sachs Local College Collaborative program for the past 4 years, guiding 40 outstanding St. Peter's University undergraduate students through this very valuable experiential learning program. Prior to joining us at St. Peter's, Professor Butkus has been a CEO, COO, and president at a number of companies, including iPacesetters LLC, Navient, and Donnelly Marketing. He also spent 2 decades at AT&T, where he held a variety of sales management, and operational jobs, including assignments as national account manager responsible for AT&T's largest customers. Ray also served as an officer in the U.S. Army Signal Corps for 4 years, where he was a company commander. Thank you so much to Mike and Ray for your time and expertise. Before I hand over today's discussion to Ray, who will set the stage for the Q&A, I'd just like to remind everyone to please keep your mic on mute during the session and only unmute if you're speaking during the open Q&A at the end. You can send questions via the chat function at any time during the session, and I'll ask everyone later to please use the raise hand feature to ask live questions when we finish the formal discussion. Professor Butkus, can you please take it away?
Thank you, Mary Kate, and thank you for that very gracious introduction. And thank you also for hosting and facilitating these lunch and learn sessions. You know, I'm mindful of the words of Winston Churchill. Churchill once said, "I've never enjoyed being taught, but I'm always ready to learn." So hopefully today, ladies and gentlemen, you will have the opportunity to learn, and we'll make the teaching as enjoyable as possible. I've had the good fortune, as you heard from Mary Kate's introduction, to work with our guest speaker, Mike Hughes, for the last 2 years. And in that 2-year period, I've come to know Mike as a gentleman, a very smart executive, a person who is articulate, as well as having a no-nonsense orientation towards business. I would point out he is not an economist, he's not an analyst, and he's certainly not a quant. What he does do is spend all of his waking hours thinking about how to maximize the wealth of very high wealth individuals, high net worth individuals and families. And so he has a wonderful perspective from a practitioner's point of view on the current state of the economy and its implications on investments. Our questions today will follow two general themes, the first of which are the general economic conditions that we confront as the world and our nation begins its process towards recovery, and the second of which are sector-specific conditions which are likely to affect the velocity of the recovery and the nature of the recovery of those sectors. So with that by way of intro, let me jump in and start it with the first question, Mike. You know, the past 4 months since our country has been feeling the horrible effects of the pandemic have certainly been a roller coaster ride for investors. We've seen unprecedented weekly declines followed by unprecedented weekly gains of the market. In fact, the NASDAQ today stands at 14% above where it was at the end of the year and a full 50% above where it was at the trough at the end of March. The S&P is not quite as robust of a recovery, but close. The Dow is trailing a bit, but across the board, we're seeing recovery in equity markets. So that is in spite of the fact that we appear as a nation to be in a second wave of pandemic. And in fact, we now stand at over 130,000 dead and nearly 2 million cases reported in the United States. So Mike, my question is, what do we make of all this? In the very general sense, what has the pandemic taught us about equity markets in general, in specific, and investments more generally?
Sure. Well, first off, thanks to Mary Kate for that kind introduction, and thanks to St. Peter's for hosting me. Ray, always a pleasure to see you again. It's been great the last 2 years working with you. Look, I think the question is certainly interesting. You mentioned a roller coaster. I don't know where we are on that roller coaster. I don't know if we're slowly ticking towards the top and we're about to come in for the big drop, or if we've already done that and now we're just kind of riding it out. I don't know. I've heard obviously if you're looking at the markets, you think V-shaped recovery. I've heard W-shaped recovery. I've heard Nike swoosh recovery. I've heard all types of different things, but I don't think the story has fully played out yet. And I think Dr. Fauci said it. You mentioned a second wave. I frankly don't think we're out of the first wave, to be honest with you. I don't think we've seen the drop off. Clearly in the Northeast, we've seen the curve flatten quite a bit, but really in other parts of the country, it's still an issue, and certainly globally, still an issue. Look, how investors, what should they be thinking about? What have they learned from this recent market decline and swift recovery? I think investors need to be realistic about what their actual liquidity needs are during periods of great stress, right? So, you think about a small business owner, for example, maybe, they have their business, they think it's, relatively recession proof. Maybe they went through the global financial crisis and they thought they were okay. They took, their retirement savings, they put it into, a more risky asset class, i.e., public equities. Well, when the markets declined and the small business owner found themselves with no revenue, right? Their business completely shut down and their investments, 30, 40% off of where they were. doesn't feel like a great time to sell those investments in order to get some liquidity. Thankfully, a lot has been done by the government. But things are looking better, right? Like the bar was really low, right? So let's be honest. I mean, in April, things were looking pretty grim, but economic, activity data has improved, right? Retail, food services sales are up, vehicle sales, mortgage applications, new home sales, all up. Manufacturing, non-manufacturing business activity, that's up. And then we even had unemployment coming down a bit, but albeit it's still, historic levels, elevated levels. It's interesting. When people are thinking about investments, I like to typically, for the sake of simplicity, I like to bucket it into 4 different asset classes, if you will, right? So public equities, bonds, real estate, and then alternative investments, i.e. private equity or hedge funds. So what's driving this rally in public equities, right? So I think first off, people have all but given up on 2020. There's so much uncertainty there with the recovery. I think investors have shifted their focus to 2021 earnings. And that's why you see the market where it is. The markets are forward looking. Number one, massive stimulus by Congress. Number two, a series of critical, policy initiatives by the Fed. Both 1 and 2, Congress, the Fed, they moved much more quickly than they did during 2008, 2009. So that's been helpful to the markets. I think 3, vaccine progress and sort of the bending of the actual virus curve. I think that's helping the public equity markets. The market breadth isn't great. I think there's a narrow group of large cap stocks. The names, Apple and Netflix and Google, that have lifted sort of this cap weighted index, while some other typical stocks have sort of lagged behind. And then just fifth, really, just the general optimism around the restart of the economy, right? People are excited to get it back out there. So I think that's what's driving this comeback in equities. If you think about bonds, there's certainly been a flight to quality. We've seen yields coming in. Certainly plays an important role in a lot of people's portfolios. Real estate, real estate's interesting. I think we've seen, potentially disruption there, lack of rental income. People, we were in discussions with one retailer who I can't name that just decided blanket, like, we're not going to pay our rent, right? In all of our stores across the country. And that was a decision from corporate. So, we've seen some of that. There's obviously illiquidity risk if you're investing in real estate. So if you need access to your money, sometimes you can't necessarily get it. And then in the alternative space, hedge funds, they don't often do their job. They don't do a great job of hedging. They just go down something less than the markets have gone down. And sometimes they don't go up nearly as fast as public equities go up. I don't particularly love that asset class. Private equity is interesting, but I think the uncertainty about how the pandemic plays out leads to uncertainty in private equity investing. And I think if you're going to dabble in that space, I think you got to make sure that you're identifying, above average, top quartile managers with some experience that can sort of navigate this environment. But look, at the end of the day, I think, if you didn't learn it from the global financial crisis, what I think investors should have learned, while in the midst of this crisis still, is that proper diversification is key, right, across asset classes, sub-asset classes, if you're thinking about a portfolio and your investments. And then also staying the course is pretty critical. One example that I always cite that I love, we did some research and dating back to 1992, so nearly 30 years. If an investor had just invested in the S&P 500 and did nothing else and just left it there, their annualized rate of return was almost 10%, right? So 9.8%. If they weren't invested for the top 10 days out of, whatever that is, 7,000 business days, if they weren't invested for the top 10 days, their annualized performance over that period of time went all the way down to 7%. And if they missed the top 50 days, it was virtually zero, right? I think annualized return is less than 1%. So, I think, naysayers could say, well, what if you're smart enough to exclude the worst days? Point is really hard to do, right? Really hard to identify, those top 1% of days or those worst 1% of days. And I think having a good plan and staying the course is really what we've learned through this.
Okay, so moral of that story is don't try to time the market.
Yeah, pretty much.
So, Mike, you mentioned this massive government stimulus, the package that was passed by Congress in April was 2.3 trillion. If my math is correct, that's just about 11% of GDP. There's some speculation that another one of 1.5 trillion is on the horizon. Not only on the fiscal side, but monetary policies that you mentioned. In fact, the question is, how are we as a nation paying for that? Simple answer is we're printing money and we are borrowing it. If you put those two monetary and fiscal dynamics together, classical economic theory would say, gee whiz, we might be seeing enormous inflationary pressure, yet we don't seem to see evidence of that in the investment market. Why not?
It's interesting. I think the short answer is that, the fiscal and monetary policy measures were designed to offset the demand shock and the liquidity shock. And they probably won't be inflationary, is our best bet. My colleagues in our global investment research division, you may have heard of some of them speak on CNBC and other places. I think they expect core inflation to remain below pre-COVID levels through 2023. That doesn't mean that it's not a serious situation. I think in developed markets you could see debt to GDP match what we saw during World War II. I think in emerging markets you could see debt to GDP at their highest levels ever. And then we had done some back of the envelope math, thinking hey, if we see another $2.5 trillion of COVID related response measures, and an extension of the 2017 tax cuts, which I don't know if we'll see that, but if we did, we could see government debt surge and be 150% of GDP by 2030. And that compares to, I think we were below 80% of GDP last year. So definitely a concern. And it's been interesting. What's the fiscal response been? I think you mentioned it, but chances are we're going to see another $1.5 trillion later this month or next. That's the number we're hearing. I think we could see the federal unemployment rate extended. That's set to expire. I think they could maybe reduce the rates. I don't know what the payout is there, but I think that could come in a little bit. I think the government's going to start to focus on the hardest hit businesses rather than a blanket PPP approach. I think 2 weeks ago or a couple of weeks ago, June 15th, they started the Main Street lending program. So that's interesting there. And then I think you could see more federal support for state and local governments, and even another round of stimulus checks. So TBD on that. On the monetary side, the Fed fund rate, they're going to be kept at zero for the foreseeable future. We may start to see outcome-based guidance from the Fed, i.e., we're not going to raise rates until we're back to close to full unemployment or, inflation is above 2%. So we'll see what kind of language comes from them. We've seen large-scale asset purchases, but I think it's going to start to look more structured like it did, during the quantitative easing phase following the global financial crisis. They've obviously injected cash liquidity into the market, and they've instituted a lot of emergency lending facilities. So, a lot's been done. But bottom line, if you're an investor, if you're worried about inflation, I think you're forced into equities, right? That's another reason the equity markets are moving higher because, cash isn't really a great option. It's not yielding much right now. Maybe you buy treasury, maybe you buy the TIPS, the treasury inflation protected securities. But I certainly wouldn't buy gold as a longer term inflation hedge. Gold's done well this year. It's up 17% year to date. But gold over time, it's barely outperformed inflation. I think the real rate of return, once you factor in storage costs, insurance, et cetera, is like 1% annualized. And that's, compared to 2.5% for the 10-year treasury. So most people think, intuitively like, hey, you got to buy commodities, you got to buy gold to hedge inflation. But I think if you're a longer term investor and your investment horizon is greater than, say, 5 years, you're probably better off with equities than you are with commodities.
Okay. Well, we've been talking about recovery to a certain degree. So I think it's pretty clear that some sectors are going to be winners, some sectors are going to be laggards when it comes to recovery. Mike, give us your perspective, beyond the obvious, of what sectors do you expect to see the fastest and speediest recovery? And then what sectors do you foresee to be more laggards in the recovery?
Yeah, that's a good point. The truth is, I don't think I technically speak for Goldman Sachs, but I would say, we don't think that the rebound in 2021 and the earnings there will be uniform across all sectors. That's for sure. I think stocks in industries that are viewed to have like better, quote unquote, like better secular growth prospects, they've outperformed those with like low and those that are in like lower multiple sectors. And I think that's going to continue to be the trend. Sectors that I think will do well, off the top of my head, healthcare, consumer staples, communications, IT, ones that maybe won't do so well, financials, real estate, maybe even energy. So it'll be interesting. I think, healthcare, for example, that's certainly top of mind. I think following this COVID-19 crisis and in anticipation of future outbreaks, we can see a lot of investment there and focus there. IT communications, pretty obvious. I think there's no slowing down, the technological revolution. There's probably a few 20 and 30-year-olds on this call that would be sooner to give up like their daily meal than they would be to give up their cell phone. So I think, we're going to continue to see companies in those sectors doing well. I think the rollout of 5G could be interesting. The folks that I'm speaking with, they talk about an increase in dependence on technology. I tend to think, I live in the New York City metropolitan area here. And, I tend to think that my cell phone service and my connectivity is pretty good. I heard it's going to be even better and we're going to become more reliant upon it. So we'll see what happens there. Things that won't do so well, financials, you think about like net interest margin, rates are low. It's hard for banks to make money where rates are. There's less transactional revenue from deals, right? Think about, traditional merger and acquisitions. Maybe it's not as much deal flow. So revenues will be down there. Real estate obviously could be challenged. There's a ton of companies. I work with a lot of private business owners of significant companies and some C-suite level executives of much larger public companies, and they're all reevaluating their actual physical footprint. I can't speak to Goldman Sachs, but personally, I know that I didn't check into one of our disaster recovery sites in Princeton, right? I don't think anybody did. I think everybody's working remotely quite well. So that'll be interesting. I think it depends on who you ask. If you ask somebody in the real estate space, what's going to happen, you might get one answer and then maybe someone else will give you a different one. So, it'll be interesting. I think, off the top of my head, at least, those would be the sectors that do well and the ones that don't do so well.
Okay, yeah, very good. I noticed, by the way, yesterday, Simon Properties, who's the largest mall owner in the country, was pretty severely hit in the market. Let's shift gears here a little bit and think about some of the trends that are coming out, emerging. You mentioned one in the context of real estate. You know, people not going to work in an office, and what does that mean for the future of commercial office space? But thinking a little bit more broadly, one of the themes that many CEOs and some economists have noticed or predicted is something called localism. Some people also call it the power of proximity. One of your competitors, in fact, refers to it as deglobalization. The point is that this epidemic has illustrated the fragility of global supply chain, and therefore a trend perhaps to emerge in the future is one where there will be a premium put on domestic sourcing and local acquisition on the supply chain. What are your perspectives there? Is it likely that we're going to see a rethinking of global supply chains and all the implications that that has on the economy? Or is this just talk?
You know, it's interesting. I think, you know, localism, I think, depending on what side of the political aisle one falls on, I think some people call it, you know, protectionism. I think we could see a shift, especially in the area of healthcare. You know, you think about critical PPE and other healthcare items. I think people were shocked to know that there was, you know, one company making masks here in the U.S. Don't quote me on that, but I think, you know, stories like that are quite alarming to folks. So there may be a shift as it relates to critical items, healthcare, obviously military, those sorts of things. But, you know, it's interesting. I don't know if we'll see cultural changes like they've seen in China. But I think it's my opinion anyway that, you know, the companies that are best suited to sort of navigate these challenging times are going to be the global companies that had experience with, you know, SARS and MERS and the swine flu. So if you're a local business, I still think it's tricky. I think, you know, certainly in healthcare, given our aging population, I think localism is key. I think some companies with a franchise model in place may be well suited to take advantage of it. I think, you know, even if you think about like a big company like McDonald's, for example, big global business, economies of scale, experience managing through crises, but because they have the franchise model in place, they're able to adapt quickly to like changing local dynamics, right? So, you know, their franchisees can get out there and, you know, make adjustments on social distancing, those sorts of things to do. And if that was centrally managed by one company coming from the top down, that's really difficult. So I think that they're a company, for example, that would give a little flexibility there. So that's, you know, it's kind of the best of both worlds, global company, global supply chain, but also at the local level, have some boots on the ground. Look, we're in the middle of a trade war with China still. You know, people forget about that. So that's interesting. We could see supply chains disrupted because of that, and even less so because of the virus. I don't know what's going to look like following the November election. I think if, you know, I don't care to get too political ever, but I think if we see, you know, Trump get reelected, we could see, you know, maybe a trade war lengthen with China. I think if we see, you know, Vice President Biden and even a sweep and the Democrats controlling the House and Senate, I think maybe it's not as top of mind as it once was. So it'll be interesting. I think at the end of the day, look, small businesses are the backbone of the American economy, but I think they're in danger, right? I do. I think there's trends that are that are out there. You know, Amazon people, consumers are, you know, they're very used to, you know, getting the product they want very quickly, and they're used to getting it at a very low price. And that's been woven into the fabric of our lives. And I don't think that that's going to change with future generations. I think it's only going to increase, if anything.
Okay, I'm mindful of the time, Mike, and I'm also mindful that we have a lot of smart people on this call that want to ask questions. So let me pose one final one, and then we'll open it up to the audience for Q&A. You know, you've talked a lot about asset classes and kind of what it portends for future investment, and you know, traditionally fixed income, cash has been sort of the refuge for risk-averse investors, but as you point out, those are paying nearly nothing, almost nothing. And what does the risk-averse investor do when fixed income are so non-compensatory?
Yeah, it's a topic, you know, that I am frequently engaged on. I was actually talking with a client about this yesterday. The truth is, and I mentioned earlier on the call, that, you know, cash isn't a great option, right? Inflation will not remain at zero forever. So if you want to keep pace with inflation, you'll need to find things to do. You know, when I work with clients, you know, typically what I've found is I try to get an understanding of how risk averse they actually are. It's been my experience that people who think they're risk averse may actually not be, and vice versa, right? So, you know, what I'll typically do is sit down and try to walk through a series of questions to help me and help them understand what their appetite for risk really is. So, you know, I'll do that here just to give you guys a flavor of how it would go. But, you know, if I said to you, all right, what's your annual burn rate, right? How much money do you need on an after-tax basis to maintain your standard of living, right? That'd be question number one. I think number two, try to understand what are your actual return expectations for the next, you know, 3, 5, 10 years. And typically, people's expectations are overly optimistic, I would say. So try to get a handle on that. You know, you think about a private business owner who's used to, you know, 20% year-over-year returns over the course of their careers, and then, you know, you look at the public equity markets and you're talking mid to high single digits. It's usually a wake-up call. So we'll talk about that. Try to get an understanding of what the investment horizon actually is. So, you know, are you, as an investor, are you investing for yourself, or are you investing for the next generation? Because if you're investing for the next generation, or even your grandchildren, you may be able to take a little bit more risk than you're taking. So that's one interesting point of discussion usually. And then just getting into the psychology of it. You know, what mark-to-market unrealized loss could you stomach seeing on paper without losing sleep at night, right? When the markets were off 40%, you know, if your portfolio goes from, you know, $1,000 to $600, like, does that make you physically ill? And if so, you know, that helps us understand your aversion or to risk. And then, you know, lastly, it's, you know, how illiquid do you want to be? Do you need to access your cash quickly for a potential business investment or other direct investment? So that'll dictate, you know, what we have someone invested in. But look, at the end of the day, this recession is likely to be followed by a multi-year expansion. We're expecting kind of mid-single digit returns for equities over the next, you know, 3 to 5 years. So at the end, if someone is truly risk averse, even though your point is, hey, bond yields aren't great, cash isn't great, I would recommend at least 50% of one's asset allocation to be in high quality investment grade fixed income. Meaning, you know, for a taxable investor, you know, AA, AAA muni bonds in good states, you know, not not Illinois, not Puerto Rico, not some places, but that's where we would typically go for the risk adverse investor. And then back to the earlier point from the first question, it's really about like a good plan and diversification.
Okay, well, there you have it. So we can look forward to that 1% return, that triple. I think now, given that we've got about 20 minutes left in the call, Dean Natus, I'll turn the management of the call back to you so you can administer the Q&A.
Thank you so much. And thanks for the dynamic discussion, Mike Hughes and Professor Ray Butkus, much appreciated. So I haven't seen questions come in through the chat function, and I hope that means that we have people here who want to do a live question. And because there are several pages on my Zoom right now, I'm going to ask everybody to use the raise hand function. I see 2 people already have their hands raised, so that's great. But for those of you who haven't done it before, if you click on the participants link on the bottom of your video screen, an option will pop up that will allow you to raise hand. So if you're having trouble doing that, you could send me a message through the chat as well. So the first question goes to Clint Sevilla, and the second question will go to Amina Muka. So Clint, if you could unmute and ask your question, that would be great.
Okay, so my question is basically looking at how much you think the rebound of the market is due to the backing of the Fed or to exuberance of investors. Because if you look at least to the exuberance part, that there's certain projections that I've been seeing that there's going to be a 9% or 10% unemployment by year end, even if we don't have a significant second wave. And how does that, like, compared to those being the Fed and versus exuberance, how would that play out during inflection points by, let's say, the end of July and by fall when there could potentially be a second wave?
Yeah, no, it's a great question. You're quoting or you're paraphrasing, I guess, Alan Greenspan, and when you're talking about irrational exuberance, I don't think it's that. I truly don't.
Okay.
I think our chief U.S. strategist, David Coxon, was on CNBC yesterday, and he was talking about the investor. And the truth is, if the investor was truly optimistic about the economy, they probably would be buying companies whose balance sheets weren't as strong as some others. And we're not seeing that. So I don't think it's exuberance. I think it's all cautious optimism. I think it's certainly the fiscal and monetary response. And when you hear Fed Powell coming out multiple times, 60 Minutes, other places, other venues saying, hey, we've got more bullets in the chamber. We're going to do whatever it takes. We learned our lesson from the global financial crisis. I think, people are comforted by that, and they're happy to dabble in the markets, but with companies that are really high quality, or that are in secular growth sectors. So, thus the not so great breadth, but the market's still moving higher.
Okay. Thank you.
Amina, you're next, and then Bill Armbruster is on deck.
Yes, thank you. My question is kind of more personal. I am interested in investing, and this is my first time, so I don't really know much about the market. However, I am noticing that the economy is not really stable. So my question to you would be, would you still tell like students like me who don't really have like steady income to go ahead and like invest on the market? And if so, like I guess like would we invest on something more diversified, or just like what's your general opinion about that?
Yeah, well, look, I think it's different for every person, the amount of risk they're willing to take. I think you have to kind of decide for yourself what your goals are. I mean, I'm happy to have a conversation with you offline your specific goals. But I think everyone's different, really. I'm relatively young, not nearly as young as I used to be, but I have a young family. I have a longer investment horizon, so I'm comfortable taking the risk that I'm taking, and I have taken over the last 20 years or so since I started out of college working in the industry. So look, I think younger people can afford to take risks, but I think it always is dependent upon the person. And I'll, like I said, I'll leave it at that, and we could, talk about offline if you'd like about your specific goals.
Thank you.
Thank you.
Bill, you're up.
Okay, Mike, thanks very much for your presentation. I would add 3 sectors that are likely to remain hard hit for the next couple of years at least: brick and mortar retail, hospitality, particularly hotels, restaurants, cruise lines, also airlines. But my question for you is, how urgent is it for Congress to pass legislation in the coming weeks that would provide additional stimulus and particularly relief for renters? I'm very concerned that a lot of possibly millions of people could be homeless if they're unable to pay their rent. And a lot of states, including New Jersey, passed, I forget the term, but ordinances prohibiting evictions for 3 months. But now already I've seen news reports about people being evicted.
Yeah, no, look, I think it's a good point. I mean, you mentioned some interesting subsectors that we didn't dive into. I think hospitality, yes. Global travel has completely grinded to a halt. I think retail, brick and mortar retail, that was an issue before COVID-19, right? So that's something that I think the industry is trying to deal with. It's interesting. I think we've seen, not to go off, diverge too much, but I think in the real estate space, we've seen, malls, shopping centers, hotels. Obviously, they've been severely, impacted by COVID-19. But some of the newer, non-core real estate sectors, you're thinking like data centers, towers, warehouses. They're actually doing quite well, and have been benefiting from a kind of physical to digital transition. Office, we talked about that a little bit. I think some issues there. On the leasing side, I think it is important for Congress to act. I think you're starting to see pressure there in Washington. I mentioned on the call, I think, originally we thought we'd see something by June 30th. I think now it's more likely that something gets done by August, if I know Congress, and it better get done by August, because even though everybody's working from home, everybody's working 24/7, and I think politicians, they love to take their August off. They love to take, their time. So I think there's going to be a big pressure to get something done later this month or early next. In the multifamily space and the leasing space, we've looked at the data, and obviously the lack of in-person tours has affected it, and we've seen a slowdown in leasing activity. But people that can afford to do it have looked to extend their rent, and we haven't seen people not paying their rent just yet. But like you said, it's definitely a concern and something that we're watching closely, because it could be a real issue in the coming weeks and months if nothing gets done.
Thank you.
Thanks. Up next is Rob Martin.
How you doing, sir? Kind of bouncing off of what Amina asked, when it comes to not only investing, but also with the job market the way it is, with unemployment being really high, and with a lot of graduates kind of struggling to find jobs in this current COVID environment. From personal experience, a lot of internship opportunities that my friends have got canceled, so they may not have that experience that major firms are looking for. moving forward when they want to apply for like, I guess, the fall or spring, depending if we do get a second wave or the case may be. What do you think is the best like option for those people that do want to get into a big firm early on, but maybe don't have that internship experience that you guys would normally kind of want to see, or that experience at all, because of COVID?
Yeah, no, look, I think, if I found myself in this situation right now, which I almost did, I came into the industry right in the middle of the dot-com bubble bursting in 2000, 2001. So, I've seen it firsthand, and I saw what happened to folks that, graduated around the global financial crisis. I think, important to get out of your comfort zone. Like, don't have the tunnel vision that you want to be at a bulge bracket bank and that's the only thing that you can do with your career. Maybe there's an opportunity to like learn a trade, do things that may not be as sexy, and become an entrepreneur, right? I mean, there's incredible, I have clients, and the firm has clients who run like giant, like electrical businesses that they built from the ground up, and other maybe not so sexy things. So, if you have an entrepreneurial mindset, I think a lot can be accomplished where there's, when there's quote unquote like blood in the streets and things aren't looking so good. I think there's definitely opportunities out there. But if you truly are focused on the business world and finance and those sorts of things, something like trying to study for your CFA or something like that, I think that's a good use of time if all you're doing is like stuck quarantined at home.
Roger, thank you, sir.
Thanks, Rob. We have Maurice Betts, and then Clint, and then Professor Rubilo.
Thanks, Mary. Thanks, Mike, for being on this call with us today. I guess, Mike, if you could talk for a minute or two about efficient market theorists, and I guess they might say, don't even watch CNBC, index funds, don't try to time anything at all, and your thoughts on that. Thank you.
Yeah, I'm a big believer in passive investing. What erodes performance over time, right? So taxes, fees. So for my clients, I try to wear a tax hat when I invest for them, and then where can I kind of keep fees down? So what asset classes are really efficient, right? Large cap U.S. equities, right? There's not a lot that I can tell you or that you can tell me about Apple that some analyst who's studying it all day long doesn't already know, right? So I think developed markets, large caps, I think it makes sense to be a passive investor there, right? Whether it's like buying the SPY ETF, or a mutual fund or that sort of thing. I think there are asset classes and sub-asset classes where it does make sense to be a little bit more active. So kind of have a core satellite approach, right? Like you do your core investing passively, and then some of the other classes. You think small caps. I think there's if you're a good investor, if you're an active investor, I think or an active manager, right? I wouldn't suggest that someone who has a day job that's doing something else try to actively invest in small caps on their own. I think it's just too time consuming. But I think if you can identify a manager in emerging markets in small caps that can actually add value and generate a return beyond what their benchmark is, I think that's something that I would consider.
Thank you. Clint.
Okay, hey Mike again. I just I try to absorb your answer, and because I do grapple with the fact that I do believe that, like as you, that the market and the economy in general will be on an upswing, whether after like a 1 or 2 year period it's generally going to go up. But I also grapple with the fact that there's many projections that a lot of small businesses are closing and high unemployment. And that answer it was a really good answer. I really do appreciate that people are investing in good balance sheet companies. But even if that we're nearing or getting close to some of the market highs previously, wouldn't that still mean that some of these companies, even with a great balance sheet, will be overvalued, and a potential shock could bring, scare people even away from those great balance sheet companies in the equity markets?
Yeah, no, look, it's a good question. I think, in this, we've looked at all the various metrics like price, price to earnings, Case-Shiller, like you look at all price to trend. Equities aren't nearly as overvalued as you might think, especially in this low inflationary environment. This is not the dot-com overvalued era. So I think there's still opportunity out there for companies to grow. And like I said, I mean, we've seen this hit. Yes, there's demand shock, but the likelihood is that we're going to see multi-year expansion once we do come out of this. Now, I'd caveat that by saying I don't think anybody knows what the future holds. I think, even the Apples of the world, they rely on, in some regards, like their physical footprint and their brick and mortar stores. And if we see COVID-20 or COVID-21 or whatever next global pandemic there is, because I do believe we'll see one, and how frequently they occur, I mean, that could be an issue, right? So your point is valid. It's tough to think that the markets are going to go higher from here, but people were saying the exact same thing, 10 years ago, 20 years ago, when things, seemingly seemed overvalued, but the market has kind of readjusted. And I think there are things that still could be good investments.
Thank you. And this will be our last question by Lou Rivolo.
Hi, Mike. Thank you very much for being a graduate of St. Peter's and see a successful Farrell graduate presenting to us today. Good stuff. My question is, the education sector is certainly going through an unprecedented time, and the feds, in setting their federal financial rates for interest on loans, have traditionally been fairly conservative, but also not really incentivizing education. This year's set of federal loans for undergrad and grad have run between 4.5 and a little over 7%. Do you think, with the president's urging for courses to increase in the fall, that perhaps July is a very critical month here, that the Fed might lower the interest rate for student loans to help incentivize and also help to expand, the environment that we all work in, and seeing downturns in student enrollments?
Yeah, that's an interesting one. I mean, I wouldn't fancy myself an expert in the student loan problem that this country is facing, but it's definitely something that's top of mind, and it could be, another black swan, so to speak. I don't see, the federal government coming out and like forgiving student loan debt, but I would imagine that we're going to potentially see a repricing among institutions. I think it's going to be really hard to justify on a go-forward basis some of the tuitions that some of the schools are charging. I mean, obviously St. Peter's, like, I want the school to be profitable and I want everyone to do well, but I think it'll be a tough sell for a lot of families and a lot of individuals that have to take on large amounts of debt when the prospects for a great job on the back end maybe aren't as great as they once were. So the truth is, like, I'm a believer in higher education. I think, an undergraduate degree is sort of becoming like the bare minimum. That's not to say that I don't have like some very successful clients that didn't even get out of high school. Maybe not even schools as good as Monsignor Farrell, but the truth is that I think there's always going to be a place for it. I just think we'll potentially see a little bit of a repricing across the board.
Great. Thanks.
Well, thank you so much to everyone who asked some great questions. A huge thank you to Mike Hughes for taking the time and preparing to be with us today. And thank you, Professor Ray Butkus, for moderating and for coming up with the idea for this session. I think it was a great success. We will continue the speaker series next week on Thursday, July 16th, where Dr. Devin Rafferty will talk about what COVID-19 revealed about the Obama-Trump economy and its ramifications for the future of US and global political economy. So a similar topic in a new direction, and we have a couple of other events in our speaker series coming up, so we will be emailing them out as we update our flyer to everybody on the call today. So again, a huge thank you to Mike and Professor Butkus, and thank you again to everybody for joining us today. Thanks to our alumni for being a part of our session as well. So everybody have a wonderful day.